Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, stocks just followed the worst week in 5 years with the best week in 3, jumping almost 6% and with market darlings like Nvidia up double digits. While not all stocks recovered, Wall Street is saying to buy once again and is shouting it in these 10 stocks. In fact, more than 9 in 10 analysts rate these 10 stocks a buy. I'll highlight the consensus winners along with stocks to avoid and stocks I'm watching this week. But first, don't miss the relaunch of our stock trading and technical analysis course. Save $150 off the course. We use fundamental analysis here on the channel to find the best stocks, but technical analysis is an indispensable tool for finding exactly when to buy and sell. The complete course includes more than 30 videos on how professional investors trade stocks and the technical analysis they use. Click through the link I'll leave in the description and check out the free preview, or just try it risk-free for 14 days. You'll learn how to find stock trades and never run out of ideas, how to identify price changes before they happen, and the top trading patterns used by professional traders. That 30% discount is only good for the relaunch period, so check out the link below or scan the QR code here. Back to our main topic, and I showed you in Friday's video the 10 stocks with the highest upside to analyst average price targets, an average 98% upside, and one up to 124% potential return. But there's another list of analyst ratings I pay attention to anytime it pops up in the weekly FactSet Earnings Insight. That's because that return upside to average price targets can be skewed by a couple of very high targets. For example, if just one analyst out of 10 had a $1,000 price target for First Solar, while the other 9 expected just $166 a share, the average of all 10 analysts would still be that $250 price target and show the 101% upside potential. For that reason, another must-watch table here is the percentage of buy, hold, and sell ratings by most and least recommended. Here you get to see the stocks with the most consensus buy ratings, the stocks nearly every analyst agrees should be in your portfolio. And folks, with more than a decade as a professional analyst myself, I know the amount of work and research that goes into these recommendations, not just randomly assigning buy, hold, or sell to a stock, but nearly going blind building cash flow models and on research involved. So the fact that analysts have reached a consensus on these 10 stocks does mean something to me, but analysts are just as prone to that kind of herd mentality as investors, so I use this as a starting point for stock ideas, not as a sure thing investment. And just like we did in Friday's video, I always start with the sector level to see which groups of stocks analysts think will outperform. Then I can drill down into the stocks in those winning sectors. Within the 11 stock sectors, more than 60% of the ratings for stocks within energy, technology, and communication services are rated to buy, while analysts only give sell recommendations to 4% of their total. On the other hand, less than half the ratings for stocks in the consumer staples and utility sectors are rated to buy, with far more ratings to hold or sell. Part of this is just a function of the crash. Stocks in the technology and energy sectors have been crushed, down 16 and 10% so far this year, so more of those stocks have likely fallen under those analyst targets and become buys on price, while stocks in the utilities and consumer staples sector are flat or even up for the year, making them relatively expensive. That sell-off doesn't explain everything here though, with healthcare stocks only down about 2% and still 58% of the ratings in the sector are to buy, just above the average for the overall market at 56% of ratings a buy recommendation. Valuations also come into play here, with healthcare stocks trading at just 17.4 times on a price to expected earnings ratio, only 6% more expensive than the average multiple they've traded at over the last 10 years. Energy stocks are one of the few sectors trading at a discount to what investors have paid in the past, that PE ratio, along with real estate and utilities. And while stocks in the technology and communication services sectors are still relatively expensive at premiums of 12% and more above those long-term averages, expected profit growth in the sectors for this year, nearly 20% in technology and 12% in communication services, is enough to overlook some of that higher price for the growth. So then putting this together helps make sense of some of these potential returns for stocks in each sector, comparing the analyst price targets for stocks in each sector with the current prices. Analysts believe the stocks in the communication services, consumer discretionary, and technology sectors are going to outperform the market with returns of 25, 27, and 30% over the next year. Underperforming the market though, but still with solid 11% plus returns, are stocks in consumer staples, energy, and financials. That sector level research helps to make sense of many of these individual stocks we see in the most recommended by analysts, but again, you can always go to the sector tracker on sectorspiders.com to see all S&P 500 stocks within each group. These are the largest 500 stocks in the United States and a great place to start when focusing on a specific sector like healthcare or technology. Looking at those individual stocks with the most consensus buy ratings, first we see United Health Group, ticker UNH, with 97% of the ratings on the stock a buy recommendation. While I like Humana, ticker HUM, better in the Medicare Advantage space, we've also highlighted UNH over the last few months. Those Medicare Advantage providers have gotten hit on lower government reimbursements and policies over the last few years, but surged recently when the Trump administration said it would be increasing reimbursements by 5% next year, more than double the 2.2% rate increase announced last year. UNH offers Medicare Advantage plans in 87% of the counties, second only to Humana in its market penetration, and has 29% of all plan enrollees, more than 10% above its next largest competitor. United Health has one of the higher growth rates of its group, with sales expected up 13% this year, and those cost-cutting seen boosting earnings. Still though, the shares aren't exactly cheap here at almost 1.4 times sales, compared to just 0.3 times on a price-to-sales basis for Humana, so I'm going to be sticking with Humana here. Delta Airlines, ticker DAL, and United Airlines, UAL, fit in with that consumer discretionary theme and also have two of the highest return potentials to average analyst targets. But I'm not quite sold here. We're seeing weakness in consumer spending, and frankly, the airline industry has always seemed like it's one ticket away from bankruptcy. Both do trade slightly cheaper than their long-term price-to-sales and price-to-earnings multiple, with Delta at 0.41 times sales and UAL at 0.37 times sales. There might be some upside potential to valuation, but I'm not convinced it's going to double the share prices. I do like the opportunity lately in some of the big tech players after the sell-off, with Microsoft, MSFT, Amazon, ticker AMZN, and NVIDIA, NVDA, all three seeing more than 9 and 10 ratings a buy recommendation. While Meta and Microsoft have gotten out of the sell-off relatively well, both down about 7% this year, Amazon, Alphabet, NVIDIA, and Apple have been hit harder among the Magnificent Seven tech giants. Meta and Google parent Alphabet could be in trouble if consumer spending falls and takes ad spending down with it, so I'm not ready to load up on those two yet. But the sell-off in Amazon and NVIDIA, along with the relatively good valuation in Microsoft, have opened up opportunities there. But just as Wall Street loves some stocks, it hates others, with 10 stocks catching from 28 to 40% of their ratings as sell. This might not seem like a wholly negative outlook, but remember, analysts on average give sell ratings to just 6% of their recommendations for stocks in the S&P 500, while recommending to buy more than half the time. It's not that analysts are eternally optimistic and see only rainbows and unicorns. It's that the big banks that employ them, like JP Morgan and Goldman Sachs, do far more business in bonds and investment banking for those rated companies. The fastest way to lose a corporate customer is for the analysts in your research department to start shitting on the stock, so analysts will just drop their recommendations usually on a company, stop talking about it, rather than switch to a sell rating. So when analysts collectively do rate a stock a sell, it's not necessarily a must sell immediately if you own it, but you do need to check your own research and make sure you've looked at that bear case argument. In the most recent consensus sell-rated stocks, we see names like Paramount Global, ticker PARA, which has all but lost the streaming wars with less than 10% market share, along with Apple TV against dominant players like Netflix and Amazon. Here with 30% of the ratings on the stock to sell, Garmin Limited, ticker GRMN, may be more of a factor of its 29% run over the last year and valuation than anything. Revenue is only expected to grow 8% this year to $6.8 billion as the company fights in a very competitive trackers market, and the shares are already relatively expensive at 5.7 times on that price to sell, so this one isn't necessarily a doomed company, but one that has just outrun analyst price targets. But here Southwest Airlines, ticker LUV, sell rating is interesting here given that both United and Delta Air are two of the most highly rated stocks and show up on our list of highest potential returns to targets last Friday. Southwest has recently sold off on its switch from a bags fly free policy, and analysts might be worried that the low-cost provider won't dominate that theme anymore. Looking now at the stocks I'm watching this week before we get to our market outlook and how to invest. First up, Ally Financial, ticker ALLY, reports earnings this Thursday and remains one of my favorite value stocks in the financial sector. While the 34% plunge in shares of longtime favorite SoFi Technologies has taken it closer to value territory, shares still trade for a price of 1.7 times its book value, that key measure of value for a bank. While Ally doesn't have quite the growth we see in SoFi, shares are trading for a deep discount at 0.85 times book value, almost exactly where we started buying SoFi on valuation in 2023. Wall Street hasn't liked the worsening outlook on consumer loans, especially auto loans that make up much of Ally's lending portfolio. But the company is a solid fintech, and while auto lending is still its bread and butter, it's also the largest digital bank with a growing business in insurance, credit cards, and home loans. Full-year forecasts are for 3.5% revenue growth and a strong 48% growth in earnings, And backing up my value stock thesis is the Oracle of Omaha, Warren Buffett's Berkshire portfolio, owning 29 million shares of Ally for a 9.5% ownership of the company. I'm also watching Netflix, ticker NFLX, also reporting Q1 earnings this Thursday, with the stock holding up really well in this year's crash, still up 2.8% to Friday. But investors need to understand that first quarter earnings have typically been a downside surprise. Shares have fallen in all 3 of the last 3 years' Q1 reports, including a 35% plunge in 2022 as management downgrades its expectations on subscriber growth for the year. Now, part of this is just the game companies play to be able to more easily beat expectations later in the year, but there is some seasonality to Netflix subscribership, and we're not sure what extent the tariffs are going to affect the company. Revenue for Q1 and Q2 are still expected to grow at a solid 13% pace, with profits surging as high as 28%, so I'm afraid the stock is priced to perfection ahead of its earnings. Netflix is still the undisputed leader in streaming industry with over 20% market share, about the same as Amazon Prime and nearly double any other player. But at a very high price of 10 times price to sales on relatively modest sales growth of 13%, I'd be taking profits or just hedging my position going into earnings. Cybersecurity stocks are once again in the news and proving why this is my top must-own theme over the next decade. In secret meetings between the US and China last year, Chinese officials admitted the government's role in years of cyber attacks on US networks, including ports, water utilities, airports, and other targets. Now, of course, the US knew these attacks, usually blamed by the Chinese on criminal networks, were aided by the government, but to have China come right out and admit it, nation, we are not in a new Cold War with China. The conflict is increasingly becoming hot, both economically and across cyberspace. Add to this the 2,000% increase in malicious programs and cyber attacks over the last decade, and every investor needs a position in cybersecurity stocks. Now, that industry tailwind has meant that favorites like CrowdStrike Holdings, ticker CRWD, and Palo Alto Networks, ticker PANW, haven't sold off to those bargain basement prices like the rest of the market, with CrowdStrike still up 8%, and Palo Alto only down 8% on the year, but you cannot wait for these to be cheap. Within the theme, I own both of these along with Zscaler, ticker ZS, and Fortinet, FTNT. Showing you the bigger picture here with the Sector Spider's sector tracker. Of the 11 stock sectors, only real estate fell last week, though energy stocks came within 0.5% from falling as well. Real estate was held back by persistently high interest rates and the idea that even with a weakening economy, higher inflation may keep the Fed from lowering rates. While value does exist in property stocks, it's probably not an environment that's going to turn around this year, or at least until we see how much tariffs push prices higher. Stocks in the consumer discretionary sector are now down 16% for the year, the worst performing sector, and for good reason. Tariffs on Chinese goods are going to hit that group hardest, and even the paused tariffs are going to see 10% import charges, and that's assuming higher rates like the 46% duty on Vietnam are reversed through negotiations. Considering the average profit margin for companies in this sector is under 8%, leaves little to no room to eat those higher costs. Tariffs passed on to consumers are going to be met with lower spending, hitting revenue, and then more competition within the sector. Updating our market outlook, there's limited important economic news out this week, which is good because investors are going to have plenty to watch in the form of first quarter earnings. Now, as I've highlighted over the past month, the next 6 weeks are going to be a catalyst that is likely to see the market bottom for the year if it hasn't already. The 90-day pause on most tariffs could mean that stocks saw their low at 4,900 on the S&P 500 last week, but earnings could still make for some very volatile days. On those earnings, analysts now expect companies in the S&P 500 to report just 7% earnings growth for the first 3 months of the year, well off the 11.7% pace of the profit growth expected when the quarter began. And stocks in 4 of the 11 sectors of the economy, real estate, consumer staples, materials, and energy, are expected to show earnings fell from last year, and 3 more, industrials, consumer discretionary, and financials, are expected to show earnings growth that is negative when factoring in inflation. And as I've been warning, it's not so much what companies say about their first quarter earnings, but about what they say for full year profits. Those estimates may be better with the 90-day tariff pause, but are not going to be rosy either. Already, analysts have cut 2025 earnings expectations for nearly every sector except financials. Earnings forecasts in more than half the sectors, that's consumer staples, real estate, industrials, discretionary, energy, and materials, have all been cut by more than 3%, and companies are likely going to try to cut these expectations further in light of the uncertainty in the economy and tariffs. Against this expectation for lower profit growth, the market still isn't the steal it might appear after that 13% drop in stocks of the S&P 500 index. On Friday's level of 53.40 and trailing earnings of $243 per share for companies in the index, the market is trading for 22 times on a price-to-earnings basis. That's a hell of a lot better than the 29 times multiple at the February peak, but still only right around the 10-year average. That leaves stocks open to more selling if earnings are even worse than expected, and investors should continue to hold some money in cash, bonds, and money market to buy in at lower prices just in case. Get your $150 discount to our stock trading and technical signals course, but only for the relaunch window and with the link in the description below. More than 30 videos on how professional investors trade stocks, along with the bonus material on fundamental analysis, trade examples, and a 14-day free trial. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.